Good afternoon, friends. Today, on Thursday, 18 June, we will be discussing various aspects of working capital and role of finance managers. To start with, my name is Pradip Namjoshi. I am a chartered accountant by education. I have been working as a finance head of various industries for last 20 years. Rather, I'll be completing 20 years as a finance head. And as a major role of a finance head, I have been controlling working capital for longer period now. As was told to me by the MIT faculties that this forum is about all working capital experts, or rather finance experts, or they have undergone the basic training in finance. So I will skip to the main what you can say comments on my working capital exposures, working capital experiences, and actions about various working capital areas. Being working capital of a company, or when we start or talk about any finance department, there are various aspects of finance department. The basic role of finance department is to receive amounts, receive money. The next step becomes you have to retain that amount, you have to deploy that amount in business. Then again, you have to spend that amount, collect back that amount, and keep on this circle rolling. This is the role of a finance manager, to keep the working capital cycle rolling. In small words or short words, we can say working capital is like engine. It keeps on rotating the wheels of any vehicle, and it keeps on running. The business has to run. We can say this working capital is particularly required for all businesses. It is part of your own daily personal functions also. Any household also requires working capital. All the businesses, all the activities, all the industries, take it from any hospital to any particular, say, hospitality industry, or take it from a temple or mosque or any other religious place to any government, political, or any other organization. Working capital or finance is the key factor. Let's talk about what is working capital. So let's go to the point number 2. Working capital components, basically we are all aware, we are all finance professionals. So working capital includes debtors, creditors, inventory, and liquidity. So actually working capital can be divided in two parts. The working capital cycle, if we see, first we have to deploy the funds by way of own contribution or by way of bank finance. Then we buy material out of that. So that is the second step. The material is converted into our products or services by spending various amounts, by fixed costs, by variable costs, by labor, by giving rent, by a lot of options. That particular goods or finished services are sold to customers. These customers either pay you some advance, or then these customers pay you after some credit period. That amount is deployed back in business after removing the margin or profits of the business. That is whole the working capital cycle. Working capital also can be divided in two parts as current assets and current liabilities. The current assets will include stock, that is inventory, debtors, or we can call it receivables, and cash and bank balance, or the liquid funds. By names, you can guess the cash and bank balance is the most liquid or current asset. It is the most fluid asset. You can just give it to anybody. The bank balance by check or by RTGS transfer or cash, you can give it to anybody, buy material or buy services. Second is the debtors, which is the second liquid asset, which you have to collect the money from some outsiders, and then you can use it for paying off somebody. And inventory or stock is a less, or a what you can say, a solid asset. It is not as liquid as debtors or cash and bank, which you need to convert it to something, sell it to somebody, and then collect the money. On the other hand, there is current liabilities. Current liabilities generally includes payables or sundry creditors, as we call it in normal accounting parlance. and then there is a bank limits like cash credit limits, etc. So we hear these two terms in always business: current assets, current liabilities. So when we reduce current liabilities from current assets, it is called as working capital. How it is financed and why it is financed, that I'll explain in my later slides. When these two things are compared, current assets upon current liabilities, that we call it as a current ratio. So general business says current ratio has to be 1:1 or 1.2:1 or 1.5:1. There is no hard and fast rule. Many books say current ratio has to be 1.2:1 or 1.5:1. But that totally depends on industry. Again, that I will elaborate in my subsequent slides. The generation of funds, maintenance of funds, deployment of funds is very important. Most important thing among all these is the speed of this cycle. Again, what should be the speed of this cycle? How many period your debtors are taking to repay your sales? How much time you take to convert your raw material into finished goods, raw material to work in progress, then to finished goods, then sell it, then collect it from debtors. Meantime, you require to pay your creditors and your overheads. The cycle has got a big gap sometimes. Like for example, I'll give you an example. If I buy material today, I take generally a month to convert that into finished goods. Say I buy plastic today, then I took some process to make bottles, then I fill it with some juice, then I sell it, then I give it to vendors, then they sell it to customers, and I receive the money after 3 months. Will my suppliers wait for that? No. I have to pay them advances. I have to buy material from them advances. Those are called as sundry creditors. So there is a gap. I deploy my material today and I get my money after 60 days or 90 days or 120 days, but I have to pay my salaries, my employees' salaries, my workers' salaries, rent, electricity, my fixed costs, say within a month. That particular gap is called working capital. So that working capital gap has to be financed by our internal funds, that is the promoters funds, shareholders funds, if it is a partnership funds, the partners funds. But most of the times this amount becomes smaller and smaller and smaller because you have to invest in a lot of other capital goods, a lot of fixed costs. The gap has to be filled by bank finance. So we can say the average working capital cost in India ranges between average is 12%. It ranges between 9% to 15%. The saddest part about it is who is the weakest person, the smallest trader or the smallest businessman has to pay more interest. Like we say in our finance term, first you have to prove to bank that you don't require a loan. Then the bank gives you a large amount of loan. Similarly, if you are poor, if you are small, if you don't have adequate collateral security, if your business is small, if it doesn't have much credibility in market, the interest rate is higher. It could be 12%, 13%, 15%. If you are a big player like Reliance or Tata's, then your finance cost could be as low as 9% or 8%. The cash-rich companies, they have a different problem. They don't have to borrow from banks, but rather they have to deploy the funds in additional business or expansion. So there is always a balance between how much you borrow and how much you retain. Again, deployment of funds we'll see in subsequent slides. In general business, we always say that a finance manager does not manufacture anything. He does not create anything. He cannot earn anything. An accounts department, a finance department, they will not earn anything by themselves. Say, if we say go to sales department, they actually create orders. They sell the products, they collect the money. Purchase department, they purchase the material for this sale. The manufacturing department, they will convert, say, plastic into plastic bottles for selling. What does finance department do? Finance department has to keep rolling all these departments. Sales department, purchase department, the HR department, all these departments, it has to give the oxygen. That is the finance, that is the money. So finance person has to be the finance manager. He cannot earn anything, but he has to save a lot of things. The finance manager has to push all the things, which we are going to see in the second slide. I would take a small interruption here. After my next slides, the faculty sirs will be putting some questions, some short questions. Those questions you'll get a minute to answer that question. There will be 4 options. It will be a simple question just to get a feedback. Generally, I give lectures to classrooms and I get feedbacks from my students, right? It's like a drama in theater. But here I can't get a feedback. So your answers will tell me whether I am audible enough and you are able to understand my speech. So, sir, can we have the next slide? Now, we have discussed what is working capital, what is finance manager role, why we need stringent controls in any company, finance manager. See, sales department is doing something. He is being given a product to sell. He knows the cost of that product. But there has to be a central team to coordinate between all these teams. Finance manager, in our industry, we always say a finance manager has to be involved or poke his nose in all departments. He has to deal with salespeople, he has to deal with sales team, he has to tell them how much is the outstanding from market, when it has to be received, how much money has been received, how much money is yet in the market is to be received, and when it will be received. So that cycle needs the money to come in from the customers, the debtors. If it doesn't, like, I'll give you a simple example. It is very easy for a finance manager to say, okay, let the sales do collection. What will happen is he has sold goods worth rupees 10 crores and collects only 9 crores. What happens? Consider any business which is operating at 5% profit. The collection has happened 90%. The remaining 5%, your profit is not received in the business. Unless and until the owners of the business get the profit in their bank account, the business is of no use to them. Thus, the finance manager will have to deal with finance marketing. He will have to tell them how much are the recoveries due, when it will be due, how much is to be written off, what is the cost of these delays, how many efforts he has to do. Finance manager has to give the recommendation कि भैया market में से 1 करोड़ रुपया आने वाला है. Can I wait for next 15 days to receive that 1 crore, or can I just give 5 rupees discount or 10 rupees discount and get that 100 lakh rupees immediately? This decision will depend on finance manager's requirements of finance for the next steps. The next step is purchases. Similarly, finance manager will have to tell the purchase manager how much funds he can provide at what intervals to buy the materials. Here materials does not mean only steel and plastic. The materials will also include the services. Like we have to do the job vendoring, we have to do the processing from outside, we have to buy the labor, we have to buy electricity, we have to buy telephone, we have to buy communication lines, we have to buy stationery. So all those lot of things every purchase manager or vendoring manager will have to consider based on availability of funds. Now, finance manager only can tell him, look, boss, I had sold goods worth rupees 10 crore in last month. I'll be receiving 9 crore rupees. My profit for the owner is 1 crore rupees. I can give you 8 crore rupees to buy the material for next lot. Or this money will be available in the month of July or in the month of August or in the month of September. So finance manager will have to communicate with purchase or vendoring manager. Stores and inventories, there is an intermediary step. I'll give you a real life example. I have money just now lying in my bank, in my company's bank. Can I buy material and say, okay, I'll just buy 100 ton of steel? No, I cannot. I have to keep that steel in some godown. So there is a holding cost. There is a creditors to whom I have to pay upfront advance. There is a transportation cost. So finance manager has to discuss with the production manager or purchase manager when the money will be available, or can I give a discount? Suppose my steel vendor says, okay, Mr. Namjoshi, steel is available at 90 rupees a kilo just now for a specific category steel. I can tell him, look, boss, instead of 90 days credit, I give you money just now. Give me, instead of 90 rupees, give me at 85 rupees. Can I do that? Finance manager will have to deal on all those things with the purchase or vendoring manager. Liquidity is the next concept, that is the cash and bank balances. It is very easy to say whatever money you have received from debtors, you are not paying to creditors, keep that money in your bank account. The bank loan is costing us around 11 to 12%. How much the FD interest is received just now? It is 5 or 6%, or for smaller period, it is 3% also. Can I keep those funds idle? Maybe, may not be. Can I keep those funds in some mutual funds, which are liquid funds? There is a risk. The day I want to withdraw them, maybe the funds may not be available, the market price has gone down. It is finance manager decision when the creditors have to be paid, when the fixed costs have to be paid, when the salaries have to be paid, for which period he has to retain those funds. It is very essential. The business owner will tell, okay, we have got 10 crores in hand, let's buy a new machinery. Finance manager will have to tell, no, boss, out of that 10 crores, 8 crores has to be given for wages, for buying material, for electricity bills. So it will be the decision of a finance manager. As I told initially, there is always a working capital gap. The gap between your receivables, debtors, cash and bank balance, less whatever is financed by creditors. This gap needs to be bridged by the promoter's funding or your retained earnings, that is the earlier year's profit. Most of the cases, this gap is bigger than what you can deploy in the business. So what is the option? The bank loans. It is finance manager's role to make finance or the funding or the bank loans. When I'm using name bank loans, it does not mean only Bank of India or State Bank of India. There are various options, like there are private funds, there are equity funds, there are mutual funds which are giving finances, there are venture capitalists, there are deposits, there are n number of documents. So it is finance manager's role to decide how much he wants to borrow, how much he wants to hold the liquidity, how much he wants to pay the creditors, and when the money should be collected. All these scenarios we can see in particularly in Indian scenarios. I have seen that most of the business run on very thin margin. So if you are selling a product, if your variable costs are removed from the product sales price, that is called as contribution, then you have to spend the fixed cost, then the amount remains is called as EBITDA, that is earning before interest, depreciation and tax. Generally in Indian engineering companies or even some product companies, most of the product companies, they work at 5 to 10% EBITDA. So sir, lekin isme interest you are saying at 12%. Yeah, so your EBITDA minus your interest cost is actually your PBT. Okay, we'll keep depreciation and tax aside just now. Depreciation is not a cash outflow, it is only a book entry. Thus, if any wrong decision by a finance manager to over borrow an amount, over borrow any funds from bank or any other liquidity available, then this particular EBITDA can be converted into loss, not the PBT. Finance manager has to have different and stringent controls on all these activities, that is sales, marketing, pricing, collections, purchasing, creditors, payments, their discount rates, their payment dates, how much stock to keep, how much stock to move, how much stock and debtors levels he has to maintain so that he can borrow from bank, how much borrowing has to be done, and finally, what is the total cost of this whole working capital. Anything wrong, business can go in loss. You can see, basically I have explained you in the beginning of my speech that there is no industry, there is no activity, there is no what you can say right from hospitals to hospitality, right from any particular, say, movie manufacturing to a mandir or any historical places, everywhere finance is required. So finance person will have to be vigilant, and in practical word, there are various things a finance manager has to monitor. As explained in my previous slide, again, the finance manager will have to be friend with all the departments. He will have to poke his nose in all the departments, but he has to be an villain, or he has to take a sword whenever none of these departments are performing. If the marketing or sales department is not collecting the money on time, finance manager has to take a disciplinary action. He has to raise the issue to the management. He has to make his voice heard. Similarly, if the purchase manager says, I want to buy steel in urgency, so I'm spending say 95 rupees instead of 90 rupees a kilo, finance manager has to put his foot down why the planning went wrong. The key role of finance manager is keeping the funding ready. He should have the funding ready. He should have the bank limits, but he should not use it unless it is essential. As I told you, every minute, every amount spent, I generally keep a cost. If you calculate 11% or 12% per annum on 1 lakh rupee, how much is that? Per day, 1 lakh rupee cost is around 33 rupees. 1 day, 1 lakh rupees cost 33 rupees for a business. So if debtors are collected 10 crores delayed by 10 days, how much? Just calculate 33 into 10 into 10. Similarly, a purchase, if it is paid 10 days upfront, 10 days below that. So I go to a purchase guy. I'll tell you a real life example where we had some additional liquidity. I asked my purchase department how much discount we get for paying them early. He said simply, sir, we are paying them instead of 90 days, we can pay them in say next 30 days. The discount available was 3%. Immediately jumped on that because my finance cost average is at 12%. I got discount of 3% for 22 months. It amounts to around 18% per annum. My limits become free. The moment I pay them, I get material at cheaper. I can bring down my sales prices. I can earn better margin. So a finance manager in practical world has to intervene in all the areas of a business. He can't be kept aside of any कि ये sales वालों का काम है, ये purchase वालों का काम है. Okay, decoration of product, packing of product is not his business. But believe me, from finance point of view, from working capital point of view, every action of every business transaction means whatever is happening in business is measurable in cost. Finance manager has to be vigilant. He has to take cognizance of all costs and try to save that. The finance manager is, again, he has to be friend with all, enemy with all. He has to be villain. He has to pull the management by their ears. Ki, boss, this is wrong. This particular department is not functioning. Can a finance manager work alone? No. The larger the businesses, finance manager will have to develop proper teams. Finance manager will have to assign specialists. Like, though I am a chartered accountant, I may not be a good costing expert. So if I want to work on inventory valuation, I want to work on inventory cycles, inventory period, production processes, what can be the savings in that? I will have to deploy proper knowledgeable person there. So finance manager has to develop his own team along with develop the various peers. Finance manager, again, he has to have control over the balance sheet, profit and loss account. He should be aware of what are the components of stock, debtors, book debts, working capital, etc. on monthly, quarterly basis. The working capital elements have to be known by the finance manager, not after the month is over, not after the quarter is over, but in advance. I'll give you a simple example. Finance manager has to be very vigilant and he has to be very volatile. Real life example I am quoting here. Whatever we had planned for my 3 companies for year 2021 in the budget meeting of February 20 gone completely wrong by March. 21st March, the lockdown started, everything changed. We thought the lockdown is for 10 days or 20 days. So we thought, okay, out of 52 weeks, we are losing only 1 or 2 weeks. Lockdown extended. We had to change our budgets. We had to change our plan. I had 3 scenarios for each company. That is called as optimistic scenario, realistic scenario, and pessimistic scenario. After 2 months, we had to change that. After 3 months, in my recent times, when we are entering into what you can say last fortnight of June, entire first quarter is lost. So a finance manager has to have total control on the balance sheet, the P&L, and the components of various items of working capital. Like how much would be my data? The simple example I'll explain you what the COVID has. Now I'll run through my quick next slide, which is on real life experiences. Why a finance manager has to be vigilant in all these areas? I'll just quote you the differences which we experience. The first, I have mentioned that experience of inventory management. I work for a newspaper company called Sakal Papers Limited. I am working for an engineering company which manufactures conveyor systems and automated car parkers. There is a huge difference about stock movements. Finance manager cannot sit in his cabin, cannot just say, okay, I have arranged for the bank limits, my job is over. He should know how much inventory he has to hold. I can give you a simple costing example. A newspaper takes 9 rupees to produce per copy, and we are buying it at 3 or 4 or 5 rupees. How do the costing works? Finance manager has to be aware of all his costing, all his inventory. If you are my second point, I am saying, if you are working for a cash rich company or a bank finance sensitive company, the bank finance sensitive company, like which we are dealing in normal MSMEs today, additional costing has to be done by finance manager to absorb the interest cost. If I applied for a cash credit limit, I'm paying bank 11 or 12%. Always this cost needs to be absorbed in my costing. I will say simply, I bought plastic, I poured juice into it, I made a bottle of it, and I'm selling it. No, you have to add another cost for all these working capital at 11 or 12% for this product manufacturing. The finance manager has to also be aware of what type of customers you are dealing with. Simply, in newspapers, nobody generally takes away your money. The money comes from circulation or money comes from your advertisement published. Most of the money comes upfront. So if you are dealing in that type of industry, you are lucky, your money is secured. Nobody dares to actually steals your money. Nobody dares to actually default. But if you are dealing in one of my companies, we are dealing with real estate guys, the builder lobby, taking out a single rupee out of builder's pocket. God help you. So a finance manager has to be aware of not only the material, but what type of customers he is dealing with. The same thing applies. He should also know from whom he is buying the material. If he is buying steel or cement, or even for that matter, any other hazardous chemicals, he is dependent on a lot of such lobbying people to whom he cannot negotiate. Finance manager has to be aware of whether you are a capital intensive organization like a product company, project company, differentiation, or capital incentive or agro based company. The total working capital cycle changes based on your type of business. So if I'm manufacturing, say, juice, I am buying vegetables, I am selling it in open market, next day buy cut vegetables or buy fruits or buy juice. The credit period here is given to creditors. Creditors I am paying at the end of the month, but whatever I process, I sell, I get everything in cash. On the other hand, if you are like in manufacturing industry, engineering industry, real estate industry, you have to buy your steel and cement by paying upfront cash, but you get your money when the profit, or even you can get some advance 30% or 60%, but most of your amount is received at the end of the project. So if your finance manager has to be aware of whether he is in a product company or he is in a project company. Similarly, what type of customers and creditors he is dealing with. Another decision or real life experience about this is, what is the appetite of your management? There are managements who like to deploy maximum funds. Well, we can see that whenever we read, we can see this business is cash rich. This business has got a lot of liquidity. Simply, in last 2 months, open newspaper, you can see these businesses have contributed so much amount for COVID help. How they have generated profit, how they have kept it in business. There are some businesses who are at that level, that stature, but still they don't have liquidity. They have not made profits. They have not kept the profits in the business. So a finance manager has to be aware whether his or her promoters or business owners are willing to retain their funds in business, or they just want to take it away, or they want only run on bank finance and run away at the end of the day. A finance manager, as I told you, a finance manager has to work on working capital, but other than that, also there are various areas. Say, for example, HR department. So finance manager has to decide about what are the fixed costs. He has to deal with the manufacturing department or the production department and tell them, look, you can't manufacture this product. This is costlier. Let's get it done from outside. Vendoring is cheaper. So product manager, so finance manager has to even advise the other departments like HR department, production department about their costing for generating profits and working capital. Challenges currently faced. Before taking the next question, I would just give you the simple example. In current scenario, particularly post-COVID session, post-COVID or during this COVID pandemic cases going on and lockdowns are still there, working capital management has become really difficult. The role of finance manager has become really difficult day by day. Simple example. Last sale was done by my company on 21st March. If I go to bank and say, I want working capital against this debtor, that is my drawing power, DP, as we call it. Bank manager will say, sorry, your debtor is 90 days plus. It is older than 90 days. I cannot give you finance against this. What to do? Can I ask my promoters to pump in more funds? Or can I use my reserves? Or can I stop my, say, capital expenditure plan? Or can I ask my creditors to go for more period? Instead of 90 days credit, I want 120 days credit. The cycle of the entire industry will go bad if everybody starts doing that. If I don't pay my creditors, he will not pay his creditors will not pay somebody else. This will go bad. Similarly, on backfiring, he will add that particular delayed payment interest in my cost. He will recover that cost from me. I have to do the same thing with my customers. But believe me, I told you earlier that you or a finance manager has to be aware about whom he is dealing with. If I am dealing with, say, builders, recovering my money is difficult. Can I recover additional cost? No. So a finance manager has to be very vibrant. He has to be very volatile. Okay, we'll move to the next slide. So before this question, I mentioned that in this COVID situation, a finance manager has to make various crucial calls, whether he wants to speed up the overall industry cycle, whether he can use his resources additionally to pay up the creditors, though he has not been able to recover from his customers. Can he ask his promoters to hold back the profits or not earn profits for a certain period, but keep the business running? Can he ask the promoters to not reduce the manpower, not reduce the fixed cost, or even not cancel any capital project? So that is the challenges finance manager is facing currently. Another aspect of finance manager's major role in this COVID situation is finance manager has to be very vigilant. Government is allowing a lot of schemes. Government or banks are allowing a lot of finance options, lot of tax benefits, lot of schemes are being made open, lot of return filing, tax payments are being delayed. So finance manager has to take a call. Every such option given or tax scheme given or discounts given by bank or moratorium given by bank will have some cost eventually. Bank बोलता है अभी 90 दिन का EMI आप पे मत करो. Is it going to come free? May not be at 11%, but still it will cost you 9%. If I keep the money idle, I'll be earning only 5%. Still there is a loss of 4%. But can I finish my liquidity? Because I don't know when my debtors will pay. So it has to be a continuous working process going on in mind of finance. Whether he can collect the money, whether he can utilize his resources, whether he can ask promoters to pump in additional funding and pay the creditors and pay the fixed cost. Along with tax schemes, etc., the one more aspect I have seen, which is like haunting many of my finance manager friends, is the forex. The foreign exchange is a major player in Indian industry. Maybe it is of software industry or IT industry. The dollar is at 75 rupees. Euro is at 86 rupees. If you are an exporter, you have exported something in March, you have to receive the money today, you can have a good dance, you can have a good profit. But you have bought something in March and you have to pay, you are not covered it by forward cover or options, then you can cry. It is a role of finance manager that at 75 rupees or 85 rupees, whatever are the liabilities in foreign exchange and whatever are the assets in foreign exchange, he has to make sure that he cannot make loss, but he has to ensure that he can make profit. There are various tools, there are various advisories, there are various agencies who can give you quotes and who can give you ideas for that, right? With this, we will move on to the last part of the presentation, which is what are the career avenues for freshers as well as the finance experts. Before that, can we have the next question? 10 times in my presentation till now. Okay, so let's move on to the last part of my presentation. Sir, can I have the next slide? Okay. Future applications and impact on business. A finance manager needs a control on budgets and variance. We have already discussed that. He is the key factor. He has to discuss with all the team members. He has to discuss what are the budgets for the next month, for the next quarter, next year, and how he is going to make the changes based on all these. The corrective action plan has to be always ready in the mind of a finance manager. He has to give advice to the top management. So the finance cost, it is important to have corrective action and backup plan. The finance cost not only limited to bank interest but promoters. Every finance manager or every student has to keep it in mind that promoters fund does not come at free. There is a concept called opportunity cost. The promoters, when they invest in business, they expect returns more than other opportunities. The capital expenditure and deployment of funds in working capital, I have already discussed this point with my previous slide. It is a decision going to be crucial and difficult day by day for every finance manager. And in near future, the profitability and survival of all these businesses will depend only on cost optimization. The cost optimization of interest, cost optimization of finance cost will convert EBITDA into profit. None of the products can have highest margins. Everybody is through competition. Every customer wants product cheaper. Similarly, we want our suppliers to be at a cheapest. Next slide. Career avenues for the freshers. This actually is a very dicey question. The freshers can have very little say in corporates or big companies about choosing their careers in working capital. They can have a selection of any small activity that they can work for collections, what you can say, vendor management, or they can say the creditors payment management, or they can work on MIS or data preparation. They can work on bank finance arrangements or submission to bank reports. But when they are working in finance department for first 5 to 7 years, that is the average period I have observed, between first 5 to 7 years, the freshers are not given any responsible or responsibility so as to even deal with outsiders. So the freshers have to understand all these terms. They have to understand what is the nature of the business, what is the promoter's mentality, how much is the working capital cycle. They have to study all those things, and then only they can start giving their inputs to the business. So freshers will have to have an attitude. Yes, I'll give you my wording. I've been working in finance department for as a finance head for last 20 years. For experienced professional in working capital management or in finance department, sky is the limit. As mentioned earlier also, there is no industry, there is no activity, there is no company, there is no organization which won't require a finance function. Working capital management is required in all industries. The bigger the size of an organization, it will have multiple number of operations. Like in a smaller company, only 2 or 3 people can manage all the finance functions like banking, procurement, treasury, collections, payables. But as the size grows, as the locations grow, as the product number grows, there will be multiple finance, what you can say, experienced professional required. There are controllers for almost all the activities, separate controllers who report to the final managers. There are some people, some silos or some verticals, I would say, like controller for collection. He is not so welcome in the company. There are treasury managers who carry some different, what you can say, collar. But experienced professionals in large companies have got tremendous potential. If you don't want to work for a corporate, if you don't want to work for a large company, because there are hundreds of people working around you in a large company, you can be a consultant, a freelancer. You can develop templates for MSMEs, for various reports, for your working capital management, for your bank submissions, for your what you can say, exceptional reporting. So as an experienced professional, you can have your own organization to do the consultancy or freelancing in finance. On the same line, we can see the next slide where MIT is also offering various courses. Can I see the next slide? Yes, these are the various courses offered by MIT. There are different branches in MIT. MIT School of Distance Education is also offering these various options for learning financial management, financial services, project management, retail management, etc. And if you have any particular doubts or something, the contact details are on the next slides, which you can refer to. With this, I would like to stop my presentation at this moment, and I would like to answer if any questions are raised by any of the listeners or students or even faculty members. First question is asked by Dr. Srinivasa. How this working capital can continuously be procured. It is a cycle, as I explained in the beginning. It has to be started with some contribution by the promoters. Then that money is put for buying material, converting that material into finished product. Then that money is received from the debtors, again that money is deployed back as for buying material and services. Only there is a gap that this money can come back to the business after 60 or 90 days, and if we have to pay the suppliers and fixed costs before that, there is a gap which has to be bridged by promoters contribution or from the business owners or banks. So this is a continuous cycle. Next question: in COVID situation, as well as we all know, the government launches some benefits to MSME sector, like, yeah. Yes, this Mr. Nishant Tanwar has asked this question. There are various schemes offered by banks. These schemes are very beneficial if your normal working capital finance cost is 11 to 12%. These schemes are available at 9% or sometimes even lesser. And this particular scheme which you have mentioned is guaranteed by central government. So the companies will not have to give additional security by way of collateral or stock or book debts. So these schemes are definitely beneficial. These schemes can bring down the finance cost, and this should be opted for. ADR, GDR can be issued for working capital. Yes, they can be issued for working capital. Can you please explain what is operating profit? Operating profit is, in our normal term, we used to call it gross profit. So for manufacturing a particular, say manufacturing a shirt, the raw material plus labor plus factory expenses, when you reduce that from sale price, it comes as operating profit, which is directly linked with manufacturing and selling of this product. After that, like salary of head office, bank interest, your communication cost, which are not directly related to the product, are non-operating expenses, and they form part of non-operating profit. So operating profit is your sale price minus the operating expenses, that is raw material plus labor plus factory overheads. Next question is working capital is being used by industry in today's situation? Yes, working capital is being used by entire industry is dependent on working capital, boss. There is nothing before working capital by your own sources. I have seen hardly 1% of Indian industry can support their own working capital. Everybody borrows from bank, and working capital is being used by industry. What will be the best WC ratio for retail business? Retail business means, if you are saying trading business, it can be 1:1. Only for trading business. But if it is a manufacturing retail industry, it can be it can be dependent on case to case basis. If it is like for manufacturing of shirts, the fabric, then it can be 1.5:1. There is nothing best in this. There is optimum ratio. Always remember, there is no working capital best ratio. There is optimum ratio. It depends on business to business, appetite of management, and availability of bank finance. If software organization budget is given to accounts manager rather than finance manager, budget is available to both of them. Rather, in today's world, almost all accounts manager report to finance manager, so budget is given to finance manager, or in 99% cases, budget is compiled by finance manager. It is not given to them. It is compiled by finance manager. He takes budget from sales, from purchase, from other operating areas, and creates a working capital budget. So it is responsibility of finance manager. He does not get a budget. He prepares budget. Can you please tell us the hierarchy to become finance manager? Sorry, I did not get this answer. Hierarchy. You have to be a finance professional, start, have patience, work for 5 to 7 years in the organization, make your finance concepts very clear, then only you can have this proficiency. If financing is though different sources, are there any documents required, like contract, bonds, etc.? Who is responsible for these documents? For documents, financing is finance manager is required, or we call it a CFO is required, or he is responsible for that. But he does not do it alone. There are other compliance officers and legal department who will always assist him to check that he is not selling out the entire company in one go. So it is a joint responsibility between finance manager and the legal manager. Sir, net profit shown in P&L account was actually available physically on liquid mode. Yes, it is more available. You have to add back certain non-cash expenses like depreciation or foreign exchange fluctuation, or there are accounting concepts like deferred tax, etc. So if there is that's why if you see a balance sheet, after balance sheet and profit and loss account, there is a cash flow statement. It is worked as a negative cash flow statement, but it gives you how much cash the business has generated. It can be worked out from P&L. Next question is how can the, sorry, how can the finance manager overcome the challenges faced in this COVID situation? As I told you in multiple slides, he has to be very vigilant, take maximum benefits. He has to talk to all departments. He has to make his budgets on monthly, quarterly basis and take corrective actions. The management of the business has to believe him and has to trust in his decisions and follow his decisions. That is only solution. Is the working e-commerce? Is it working capital used for e-commerce field? Absolutely. There is no business, there is no activity without working capital. Project reports are made for borrowing of money for working capital, just like other loans. Yes, that report is particularly called as CMA report, Credit Management Analysis. It is submitted to bank on yearly basis, and a quarterly report has to be given bank on actual performance. So project report, it's not called as a project report, but it's a working capital report. And even at the end of each month, to calculate the drawing power or DP, there is a report given as MSOD or SBD, that is the statement of borrowings and debts. So that report is to be given to each bank by a finance manager. What are major areas to be concentrated working? All the areas I mentioned about the collections, debtors, the creditors, the payables, the cash and bank balance, bank borrowing, inventory, and finally the creditors and payables. All these areas have to be managed or focused by a finance manager. Cannot be only on one or two areas. If you concentrate only on collection and you start paying your creditors haywire, your working capital cycle will go for a toss. I think I have answered most of the questions. If any other questions are there, the department will create a separate email for that and it can be answered. Okay, I'll take up the last question. Everybody in this COVID situation tries to increase their rates. What should be our strategy? Depends again on your situation. If you are in a commanding position, yes, you can increase your rates, but most of the cases it will not work. People will have a lot of other options. The competitions in this scenario will play a very dirty role about rating and pricing, and you will lose your business if you are just trying to increase your prices. It won't work. There are a lot of competitions available today with excess capacity but no customers. Everybody is trying to reserve, they are not buying now. So to make it faster, yeah, you cannot just increase the rates. So if somebody says, okay, instead of 10 rupees, now my product is available at 12 rupees, you can say just, I don't want to buy it for next 2 months. He will sell you at 9 rupees. Everybody is trying to pull down each other. It's good or bad, time will tell. Okay, I think, sir, we can stop for the moment, and if there are any other questions, they can be addressed to the MIT SD contact details which will be provided, and I'll try to answer them in an Excel sheet.